Welcome to beautiful Vancouver, British Columbia. Tom Jeffries and HowStreet.com's YouTube channel. Today, our special guest, Dr. Marc Faber. Dr. Faber is the guy literally they go to at central banks or basic large institutions to find out what the heck is going on. We're really pleased to have Dr. Faber back with us. And if you want to visit Dr. Faber, check out gloomboomdoom.com and also his wonderful book, Tomorrow's Gold. Dr. Faber, welcome back.
Yes, thank you.
Good to see you.
Nice to see you.
Looking at the numbers here, we are Friday, May 8th. Looks like the Dow, the S&P, fairly good. Are we topping here, or what do you think?
Well, the case is like this. As you know, in the second half of 2008, markets got hit very hard, and then the S&P in the US dropped to 741, and then it rallied to 945 on January 6, 2009. And then we went down again to 666 on the S&P on the March 6, 2009, and since then we've rallied to, as of today, 929. So I think a lot of stocks have bottomed out. The emerging markets, especially in Asia, they all bottomed out between October and November of last year. Copper bottomed out on December 28th of last year. So I think many shares have bottomed out. We had a very strong rally near term. I mean, on a 10 days basis, the market is overbought, but I think what we could have is a correction here and then another push on the upside into July.
Dr. Copper is always a leading indicator. We've talked about in Economics 101. What do you think Dr. Copper is saying to this market, Dr. Faber?
Well, the copper is up close to 70% from its low. And I'm not sure that markets are telling you very much about the economy and about how the global economy will perform, but it may tell you something about the money printing of Mr. Bernanke and the deficits of Mr. Geithner.
Let's talk about M3 and the money printing. I'm hearing numbers as high as 10% a month. Is it literally going skyrocketing here?
Well, the balance sheet of the Federal Reserve is expanding very rapidly because they're purchasing all the garbage and now also treasury bonds, which are also garbage,
right,
but of better quality garbage than the other ones.
Right.
And so, yeah, there is a lot of money printing, and when you have escalating fiscal deficits and easy money, eventually you get inflation. And I want to describe how this process of inflation then comes about. Basically, now you have zero interest rates on the Fed fund rate in the United States. And so interest rates on the short end, treasury bills and so forth are practically zero.
Right.
And the deficits are rising very rapidly. I think this year the government will have to issue in the order of $2 trillion worth of bonds in the US. Now, at the moment it's not a great problem because there are no great inflationary pressures, but equally there's no deflation. Now, considering that the economy fell off a cliff between September and March of this year, September 2008 until March this year, it's actually remarkable that we don't have deflation. Your insurance premiums are going up, the educational costs of your children are going up, and your healthcare costs are going up. So where's the deflation? Maybe the flat panel TV is coming down in price, but when they introduced calculators, they also went down. That I don't call deflation, but I call productivity improvement and moving from high technology into a commodities market. Each product goes through that cycle. In any event, the problem will occur when the economy one day tends to recover and when inflationary pressures will arise. At that time, the Federal Reserve should increase interest rates forcefully, not like between 2004 when the Fed fund rate was at 1% and they increased it to 5.25%. But there was never any monetary tightening occurring at that time, and it led largely to this huge housing bubble we had all over the world. In any event, I think the next time the Federal Reserve should increase interest rates, they'll be very reluctant to do so for the simple reason that they are holding a lot of bonds. After a 27 years bull market in bonds, in other words, interest rates came down since September 21, 1981 until December 18th, 2008. After this bull market in bonds, the Federal Reserve and the Treasury should sell bonds and not buy them, but they're buying them. That's the crazy thing. And so when the Fed should increase interest rates, they'll be reluctant to do so. They will be below the rate of inflation, below the rate of GDP growth. That will be very inflationary.
I noticed the latest bond sale in the United States, the treasuries did not go well. We've seen a complete slacking off. The Chinese, everybody backing off for the uptrend.
Yes. Well, I mean, you know, as I said, the bond market had a rally. The yields peaked out in 81 in September on the 30 years at 15.84%. Then we fell to a low. There was a panic buying into treasury bonds because people were so insecure at the end of November, early December. So the yields fell to, on the 30 years, to 2.53%. Now on the 30 years, the yield are back up to over 4%, 4.25%. And we've had, I mean, already a colossal bear market in bonds. And I think, I mean, for the next 20 years, US bonds will be in a bear market.
Let's talk about green shoots. I see all the public officials coming out, wringing in their hands, saying, oh, things are getting better. We've got green shoots. You talk about green shoots is because all the money being thrown on the problem?
Well, I don't think that we see a lot of green shoots. It's just better bad news. Okay. The news, and as you know, the government can massage economic statistics. But basically the economy and this flooding the system with liquidity and creating large deficits is rather negative from an economic point of view than positive. But what it can do is, of course, support asset markets, real estate, stocks, and inflate again something. And at that, they may be successful for a while. But what you will get is a lot of volatility. So, in essentially, since March 6th, we are now May 9th. In 2 months, the market went on the S&P up 37%. It's a big move. It's a bull market. It's maybe a bear market rally in the sense that the S&P want to make a new all-time high. But I mean, 37% is a big rally, and I can name you a large number of stocks. They more than doubled. Citigroup went from $1 to $4.
That is shocking considering all the news we've had of the financial sector, started with Lehman, the
Well,
cascade.
but I mean, people have to understand, markets peak out on good news and they bottom out on bad news. And if someone doesn't understand that, then he shouldn't invest.
It seems so simple, doesn't it?
Yeah,
Seems basic.
That's why I turned, actually had a Bloomberg interview on March 6th. I said, now we get a rally because sentiment was very negative. The market was deeply oversold. It wasn't a very difficult call to make.
The voice in the background, by the way, a cruise ship heading off to Alaska. We apologize for that. Maybe we should jump on the boat. Let's talk about commodities. Copper. It's a pretty strong rally for commodities, and then it all of a sudden fell off the cliff. Anything positive coming out of that sector?
Well, I think that a lot of commodities, they look very attractive. Natural gas has gone up by something like 40% in 7 trading days now. Sugar looks interesting. I mean, the whole CRB had peaked out in May 2006 at 365. Then we dropped to around the range of 280 to 320 until Mr. Bernanke cut his interest rates on September 18th, 2007. And then the CRB went ballistic and peaked out at 473 July 2008, and then it collapsed to 200. Now we're back above 240. The bottom formation of the CRB looks very interesting, and I think if they print money, they'll drive commodity prices up actually more than equities.
Our guest is Dr. Marc Faber. Check out Dr. Faber's work. It's terrific. It's at gloomdoomboom.com, and the book is called Tomorrow's Gold. I suggest it highly. This is Tom Jeffries for HowStreet.com's YouTube channel. Thanks for watching today. Appreciate your time. We apologize for the cruise ship in the background. We're going to buy some tickets in a minute.
Yes.
Comments made on How Street Video and HowStreet.com are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at HowStreet.com. How Street Video is a production of How Street Media Incorporated.